What if I told you there's a way to protect your investments just like insurance protects your home? Think about home insurance for a moment. You pay a small premium to protect against a big loss. Options work the same way for your stocks. They're your financial insurance policy. So what exactly is an option? It's a contract that gives you the right, but not the obligation, to buy or sell a stock at a specific price. There are two main types of options: calls and puts. Let's look at both. Call option gives you the right to buy at a fixed price. You use calls when you're bullish and expect the stock to go up. A put option gives you the right to sell. You use puts when you're bearish or want protection. Let's break down what's inside an option contract. Every option has four key components. The underlying asset is what you're trading, like Apple stock. The strike price is the locked-in price where you can buy or sell. The expiration date is when the contract expires. And the premium is what you pay for this right. Here's the beautiful part. As an option buyer, the premium you pay is the maximum you can lose. Your downside is capped, but your upside can be huge. Now let's visualize how call options make money. This is the famous payoff diagram. Imagine you buy a call option with a strike price of $120 and you pay a $10 premium. If the stock stays below 120 at expiration, your call expires worthless. You lose the premium, but that's it. Your loss is limited. But if the stock rises above 130, your break-even point, you start making profit. And here's the exciting part. Your profit potential is unlimited. The higher the stock goes, the more you make. Put options work the opposite way. They profit when stocks fall. Say you buy a put with a $100 strike price, paying an $8 premium. If the stock stays above 100, your put expires worthless. You lose only the premium you paid. But if the stock crashes below 92, your break-even point, you profit. The lower it goes, the more you make. Maximum profit is if the stock goes to zero. Now let's understand what you're actually paying for. The option premium has two parts. Intrinsic value is the real value if you exercise the option right now. If a call has a $100 strike and the stock is at 104, the intrinsic value is $4. Time value represents the potential for the stock to move more in your favor. More time until expiration means more time value. Here's the catch. Time value decays every day. As expiration approaches, this value melts away. That's called theta decay. So why would anyone use options? There are four powerful reasons. First, leverage. One option contract controls 100 shares. You can control a lot of stock with a small amount of capital. Second, protection. Puts act like insurance, protecting your portfolio from crashes. Third, income generation. You can sell options and collect premiums. Fourth, flexibility. You can profit whether the market goes up, down, or sideways. Let me show you a real-world example of portfolio protection using puts. Say you own 100 shares of Apple at $150. Your portfolio is worth $15,000. You're worried about a market crash, so you buy a protective put. Without the put, if Apple crashes to 100, you lose $5,000. But with a $140 strike put, you can sell at 140 even if the stock is at 100. Your loss is limited to just $1,500 including the premium. You saved $3,500. Let's recap the key points you need to remember about options. Options give you rights without obligations. Calls let you buy, puts let you sell. The premium is your maximum loss when buying. Options offer limited risk with unlimited potential. That's the power of options.